Hey, everybody. I know we had just finished quite a long section about why we've decided to focus on the majority of our CMHC Select operations in Alberta, but now this is the part that everybody's been waiting for. We are going to talk about the actual program. Now, there's going to be a lot of information, so don't worry. We'll be sending out a recording of this deck so that you can go back and basically reconfirm what we discussed now. And more importantly, at the end, bear with me, there's a lot of information. At the end is what everybody's been waiting for. We are going to go over the financial projections and look at those incredible rates of return and why everybody is thinking about getting into this program. So let's begin. This section is called Investing with CMHC MLI Select. And again, we are First Access Realty. So everybody's heard about the mythical animal, the unicorn. Something of myth, of legend, of lore, where you've heard about it, but no one's actually caught one. No one has even seen it. Well, when it comes to real estate investing, I've called a certain type of investment the unicorn. And this is a term I phrased years ago because there's one question that almost every investor has always asked me, run request. And when I speak of every investor, it's not like 10 or 20. We've done close to $1 billion worth of transactions in the past decade and close to 1,000 people we've assisted. And they've always asked me the same thing. Costas, First Access Realty, First Access Condos, can you help us find something that has capital appreciation in the forecast, but gives us great cash flow monthly? And my answer has always been pretty much no, they don't exist. You can either be in markets like Toronto or Vancouver, where the 10-year, 5-year forecast is appreciation with your product on your investment, but very little, if not negative cash flow. Alternatively, we could take you to markets, an example of which is Windsor, Ontario, where you are going to generate cash flow. You are going to get a monthly return, but be prepared that 5-10 years of that from now, your asset might be worth the exact same on resale than the date of purchase. So you couldn't get both. But I am very proud to announce that through this program and the fact that we are doing this in markets like Calgary and Edmonton that have very healthy population increases forecasted and economic increases forecasted, you are not only getting capital appreciation, you should be getting the best cash flow through this program anywhere in the country. So why invested in this program? Myself, I've been selling real estate investments for over a decade, and we've learned that through the CMHC program, we realized early on that it was a game changer because it offered strong rental returns in cities with capital appreciation. The rarest of combos in today's markets, and a real estate unicorn for real. So we are not CMHC. I need to clarify that. I don't know how anybody would think that, but I want to clarify that. But we are going to talk about CMHC and the program that they offer, which we combine with properties and developers that we're working with and allow you to capitalize on it. If you call up CMHC and go there, they do not have projects. They are just the insurer. But let's talk about CMHC so you understand who they are. They are the Canadian Mortgage and Housing Corporation, and it's a federal program to encourage housing. It provides financial solutions, including mortgage insurance to buyers. And that's mostly what everybody knows about them, that they provide insurance allowing buyers to buy houses when they really don't have the 20% down that's required. They have two arms, a residential division that does that insurance for personal residences, helping first-time buyers, and they have a commercial lending division, which almost no one knows about, which is actually responsible for building more rental housing across the country. Overview. The CMHC provides loan insurance for multi-unit developments to allow for favorable financing options. That is this program. They have a tiered incentive program based on affordability, accessibility, energy efficiency, and we guarantee that our projects satisfy all three criteria. Affordability requirements must include an affordable housing component. And affordability is based on local markets and lower premiums for higher affordability benchmarks. This is an important point. This doesn't mean we're building ghettos, slum buildings. We're not building low income housing across the board. It means that we need to get creative, and creative we did. We put the affordability component as smaller units or even basement units. And we can also charge higher auxiliary fees, a fee for parking, a fee for access to certain stuff. Depending on the size of the building, it depends on the access. But when you're starting at the entry level, there's additional fees for parking, utilities, or extra, et cetera, et cetera. Here is an example of one of the ones we just sold in Edmonton. And I want you guys to see the finishes and look to see the actual product. And this should really put to bed any ideas that you're going to be a slumlord and you don't want to get into that segment of the rental market. This is a great eightplex, finished in Edmonton, like I said, ready to get leased out. Fantastic opportunity, but this is kind of the benchmark for quality. It is here or above, and this is what our builders provide, and this is what our product provides, and you in turn will have tenants occupying this, and you can see it's mid to higher end, going to attract a mid to higher end clientele. And in places like Edmonton and Calgary, with their landlord tenant laws, you will get good tenants that pay their bills. And as we see here, the mechanical room, each unit has their own mechanical. So don't think there's going to be one thermostat where you have in places that have a basement apartment and one unit is at the mercy of the other unit. No, each self-contained unit, each controls their own climate, each has their own meters. MLI Key Benefits. And this is why we're doing this. And this is what brings us that super high cash flow that we don't find in any segment of the real estate market. Extended amortization up to 50 years. Most commercial mortgages and residential mortgages have a 25-year amortization. The amortization is the time period, that it would take to pay off the loan with that current payment. 25 years regularly. This is 50 years. And this is one of three main things which makes this program exceptional. So 50 years, double the time to pay, half the payments monthly, creating cash flow. Up to 95% loan to cost financing with as little as 5% down. This is not a guaranteed 5% program, but as we present the programs, they have been reviewed by appraisers and the bank that we deal with. And currently they would qualify between 5 or 6% down, which is 94 to 95% financing. Nobody can really know if it's 5 or 6. A lot of that has to do with how much risk is at the underwriter's desk, and no one can forecast that for that week or month. But currently that's where they qualify. We also have a safeguard that I'll talk about to protect you even further. Below prime interest rates, our bank does the Bank of Canada fixed rate plus 1.1%. Currently, that would bring you around 3.9% for your commercial mortgage, which is unheard of. Also, you either can choose a 5 or 10-year fixed term, which guarantees you can properly forecast future cash flow and expenses. This means guaranteed high ROI and positive cash flow. In fact, and we're going to discuss this in a bit, if it's not making or forecasted to make a certain amount of profit, it will not be approved in the program. MLI Select guarantee positive cash flow. How can we essentially guarantee this? And I don't like to guarantee because nothing is guaranteed, but this program has safeguards in place where it is as close to a done deal as can be possible in any investment. And let's talk about them. Third-party sanity check. What does that mean? That means that the projections are not based on what I think. Again, they're based in consultations with the local appraiser, the bank, because the bank will review it against an external numbers. And whatever we put, if it doesn't match them, they'll cross them off and use yours for their approval. Remember, the bank is doing the lending, CMHC is doing the insuring. But because CMHC is going to insure this, they will also do a review of the pro forma, compare the numbers and rents on the pro forma to what they have from Stats Canada, and they will cross out numbers that don't match their own. So that's why you'll see CMHC benchmark on a lot of our stuff. CMHC conducts its own analysis of cost, rents, etc., to determine the project's cash flow. Projects only qualify when when the cash flow is 110% of cost. 110% of cost means the 100% covers the expenses and the 10% is your profit. So that's right. If they don't generate 10% profit, it doesn't meet criteria and doesn't get approved. And you will never find rental properties in areas with cash flow appreciation forecasted of 10%. You will find them at 4 or 5. So this is a minimum of double. And you will see later on how we go triple, quadruple, even 5 times higher returns. Leverage government-backed financing to maximize your investment. The reality is, why are we going to swim upstream when we can profit by working with the current? And that's really what we're doing here. We're capitalizing on government programs to swim with the current to have the support of stuff available to us so that we can maximize returns and at the same time provide desperately needed purpose-built rental housing across the country. So we are helping the country, doing something in the nation's best interest, but at the same time profiting from it because we are making an investment. This is sleep well at night stuff, everyone. MLI Select, a turnkey investment. What is handled with the buyer? Through our programs and our packages, everything is handled. Land acquisition, entitlements, site plan and design, construction management, the CMHC application and the loans process through our contacts, construction management, lease up and stabilization. That's right. We do the initial lease out because what a lot of people don't know is this will not be approved until leases are in hand and actual numbers can be verified. And then we offer options on ongoing property management so that you can feel safe that these are property managers that we have experience with, and you can choose either A or B or C and go out on your own. Now, how do I qualify? Great question. This is not a personal loan, and it won't show up on your personal portfolio, so it won't affect you buying a house or a condo or a cottage, etc. This is on the commercial side. And because of this program, qualification is a little different. The bank will ask you for all the normal documents for qualification and pay attention to everything to make sure you're viable. But the main qualifying criteria are these 3. You need 10% liquidity of the purchase price and 25% assets net worth of the purchase price as well. And in that, you're going to require 5% to be put down as a down payment. Other teams get 7.5 or 10% down, but us with our builders, because of our track record, we can lock it in for as little as 5% down. That can be part of your 10% liquidity, which can be part of your assets as well. So that is the real qualifying criteria. So example, 8plex in Calgary, currently around 3.2 million. You will need total assets of 800,000, which is 25% of 3.2. And you will also need liquidity of 320, which is 10% of 3.2. This can be in cash on hand or line of credits or something that is easily accessible. And for your deposit, you will need 5% of that which would be 160. Summary, what is it in a nutshell? So we know if someone was to quiz us on the street, we'd be able to knock off these points. It is a government-backed loan, up to 95% financing with a 50-year amortization and an either 5 or 10-year fixed term. The interest rates are below prime. It is reviewed as a third-party cash flow sanity check, which means it is not only reviewed by us, it is reviewed by CMHC and by the bank. So the numbers are reviewed by 3 different groups of individuals. And no one wants to work on something that won't work out. So because we don't use third-party mortgage brokers, the bank will tell you early on if you are a viable candidate or not, because they will not work on it if it's not going to pan out. Okay? And most importantly, no construction escalation clauses, fixed price construction, similar to any other pre-construction you purchase. The price that you agree on is the price that is finished and delivered. So now I'm going to talk about leveraging. So for a large part of our life, we are told that don't carry a lot of debt. Debt is bad. Pay stuff off. And in a lot of aspects of our life, that's valid. But when it comes to investing, if you have a great opportunity to borrow at a low rate and have an opportunity to leverage, to use borrowed money to make yourself money, and if the borrowing is less than the profit, then you are doing well. And that's what this is actually. It's a leveraging play. So bear with me, and I'm going to go over a couple of slides to explain leveraging. And this is when it's good that you're going to have this in front of you to go back and follow it, because there is a lot coming at you. Why put 5% down as opposed to putting more? To optimize your finances, you should leverage properties to grow your cash flow. If a house costs $10 and generates $2 a year in rent, paying it off means you have 10 tied up and the houses are making only 2 a year. So now, if you only put $1 and the other and leverage the other 9, you might only cash flow 50 cents per house annually. At first, this seems worse, but now you can buy 9 more houses. Each one cash flows at 50 cents, so now you're making $5 total as opposed to 2. This is 2.5 times what you'd earn if you paid off one house. Plus, each house is gradually paying itself off. In 5 years, you'll have built up $5 in equity, combined in all 10 houses, and you can buy more houses, increasing your cash flow even further. So you pull out, you keep buying, you pull out, you keep buying. After 5-6 years, you could end up with 15 houses, cash flowing $750 a year and holding $30 in equity, compared that to just owning one paid off house, which gives you $2 a year and $10 in equity. At the end of 5-6 years, you'd have $62.50 in cash flow and equity from leveraging, compared to $20 if you only owned one house. That's a $420 return. That is significantly better. Now, what type of returns are we looking for? Now, remember I said it had to be 1.1 or 110%. That is the debt coverage ratio. And that's how this is qualified at CMHC for the insurance. In Calgary, we're looking at debt coverage ratios of 118% to 122% on average, and in Edmonton, north of 125. That means plus 20% returns in Calgary and plus 28% returns in Edmonton. This is if bond rates come down. They started to drop again before people tell me, oh, they've been going up, they're on their way down again. And if they drop and we finish at around a 3.5 to a 3.75% interest rate, you should be around here. Currently, our interest rate is around 3.9%, which is slightly lower. You're looking at 22 to 24 in Edmonton and around 20 in Calgary. Here are the areas we work with, and the next slide will give you a map and you can actually visualize them with cute little red squiggly circles. Bowness, Montgomery, Banff Trail, Capitol Hill, Tuxedo Park, Ross Carrock, Radisson Heights, Killarney, and Oak Ridge. So the top 5 are in the north end of the city, northwest focus. We don't do a lot of business in the northeast. It's not really where we're going to do this. And the bottom 4 are in the south part, with 3 being on the southwest and 1 being on the southeast. Let's see the map. There we go. Now, what's the whole process? Similar to a pre-construction, what we did is we took the pre-construction model, which has proven to be the most prolific way of selling and acquiring real estate, essentially in human history, outside from invading another country, okay? And we have fused it, created a hybrid of the program where we take the CMHC MLI qualified properties and combine it with pre-construction. So you pick a project, you sign a contract, you put in a 2.5 to 3.75% deposit, refundable, for the duration of the 14-day cooling period. That's when you ask all the questions, do your research, have a conference call with the bank, have a conference call with the Alberta lawyer who also sets up your corporation, okay? Once that term is completed, 2.5 weeks for smaller projects, up to 2-3 months for larger ones. Then you put your additional final deposit, which is the exact same amount as the first one. Again, that is your rescission due diligence period. You can back out for any reason. Once that period is up, you go firm aside from being qualified by CMHC and the project qualifying for CMHC. So you're always contingent on those 2 things for the duration of the build till leased out. CMHC application, you apply for the certificate of the insurance called COI, and we try to time this to be ready about 6 months to 4 months before completion because it's valid for 6 months and we don't want you to pay a renewal fee. So the real work on the application starts about 3 months in, given a 10 to 12 month construction timeline. Construction continues. Typically at this point, final closing is 7 to 8 months away. Then you approach final closing. Our teammates in town rent out your property. The leases get sent to the bank. Bank submits them to CMHC, final approval, and you are a landlord of a brand new multiplex generating that ridiculously good cash flow that we forecast. Now let's talk about First Access Realty and our team of partners that we work with and what sets us apart. Our deposit is fully refundable. If CMHC doesn't approve either you, the person, or the project, deposit returned in full without deduction. And this can happen at any point in time during the construction timeline of up to 12 months for the smaller projects. In addition to that, and I know this for a fact, we are the only team across Canada who puts in writing a contractual protection clause saying that if something happens to the rental market in that region and you are no longer approved with financing of 90% or better, then the developer has to either lower the purchase price to make it work at that threshold, or you get your money back. So you can sleep well at night knowing even if everything goes sideways, the maximum I need to put down is 10%. And other people won't tell you this, but technically these can be approved at 81% all the way to 95%, and this makes sure that you are safe. Deposit stays in a real estate brokerage trust account. It never gets released to the seller or developer. Unlike other parts of the country, in Alberta, it is common practice on pre-construction sales to have all or part of the deposit released to the builder during the construction period. We do not do this. This stays in a real estate brokerage trust account, just like buying anywhere else in the country, and just like buying resale. Tier 1 bank funding. Again, a first for First Access Realty and our team. We are the only ones that we know that get funding through a tier 1 bank, and actually the largest commercial bank, Canadian commercial bank in North America. The big five, the big banks, the ones we all see on the streets and on the corners that we go to, they tend not to fund these projects. The majority of our competitors use third or second tier commercial banks who you've never heard of that are broker channel. So you have to pay a mortgage broker 1% who works on commission. So imagine the implications there. And then pay the lender 1% to fund you. This does not happen with us. We have a flat fee of $8,000 regardless of the mortgage amount, and the purchase price negotiated to match appraisal. Because there was a technically temporary drop in rental rates the second half of last year in Calgary, and we saw rates come down, we used one appraisal that we ordered this spring to help renegotiate the purchase price for 4 of our buyers down anywhere from $100,000 to $130,000, depending on region. Rest assured, we will do the same for you because we want to make sure you meet that threshold. And if prices went down, and these are evaluated on pricing of rents, we will renegotiate it to make sure it works. Now, numbers. Let's talk numbers. This is going to be an A-plex in Edmonton. So remember, these are verified by local appraisers, so the numbers aren't just pulled out of thin air to make us look good and to make it appealing. These need to match. So rents in Edmonton, vacancies around 3%, hasn't really swayed the last couple of years, staying healthy, staying steady. Rents for a brand new upper 3-bed, 2.5-bath townhouse is around $2,250. The affordable rents in the basement for a 2-bed are $1,250, but we kept the other 2 basement units at $1,250 so we can do better in reality as opposed to worse and increase the opportunity of refinancing. We'll talk about that later. We have all our expenses. Notice the CMHC benchmark. Those are numbers from CMHC actually, okay? Terminal cap rate of 5.67%, annual debt service $96,000, cash flow before taxes $39,551, bringing you an annual cash on cash return on your investment, on your deposit of 33%. That is unheard of. And again, this is an interest rate with 3.5. We're currently at 3.9, so you're not far off. Calgary, rents came down, appraised values came down. We're currently at 3.2 for a lot of the regions we're selling. Uppers for brand new, and again, this is brand new, not 20-year-old product, about $2,750. Always a shortage of new product. People pay a premium. Again, 3-bed, 2.5 bath. Our lower 1-beds, 1 baths are at $1,600. Sorry, Edmonton was also lower at 1-beds. We kept the other two, again, like Edmonton at $1,600, so we can pleasantly surprise. You have effective gross income of $214,000, operating expense of $175,000, cash flow $46.5. That brings us a cap rate of 5.48 and a cash on cash of 29%. Why is there better cash flow in Edmonton? Historically, there's better appreciation in Calgary, and Calgary is better insulated from rises and drops in the oil and gas sector. So you may get a little bit more at Edmonton, but historically, there might be more fluctuations. Either way, 30+% plus minus returns on rental properties with 5% down and the ability to refinance and pull your money out. What's that? I could be in for $0 and making these great returns. Yes, because with 5% only down, the amount of money you're mortgaging to pull that 5% is very low in comparison to the return. So let's go to the next slide. Can it get any better? Of course it can, and that's what I was inferring to earlier. Let's talk about it. Paraso. What is this weird term? It is Latin for side by side or equal footing. And when it comes to the world of lending, it basically means you can get a new mortgage on the same terms as the first, and then they piggyback. And that's what it is. The pari passu is a second mortgage allowing you to pull out some or all of your initial down payment while still keeping the same terms and basically be in for $0 when rents go up a little bit and you get a new appraisal and the value has gone up. And because you're at a threshold of 95% loan to value, it technically only has to go 5 to 10% to do this. And that can work out to just a 10% rental increase. When do I start paying for the loan? These are FAQs and very important. You start paying for the loan on the majority of these once it is built and you get possession. If there's a construction draw method, which I didn't go into, that is basically the payments are covered by the loan. So the loan is covering the payments. So in reality, you, the investor, you, the purchaser, don't spend any money out of pocket until you own it and have possession. Why do I see so many Alberta packages and very few Ontario? Main point, I do not want to be a multiplex owner, have multiple tenants under one roof in a province that is so anti-landlord as Ontario. Secondary reasons, development charges and land transfer tax, aka excessive government greed, throw off the numbers in this province. When do I take full possession and how do I take possession of an empty building? How am I going to find tenants when I live halfway across the country? You do not get possession of empty buildings. For this to be approved, it needs to be stabilized, which means the amount of rent being generated covers the expenses to carry. That's when final approval happens, and that's why my team does the initial lease up. Am I locked into this property for 5 or 10 years, the duration of the mortgage? Do I have exit options? Of course you have exit options. You can sell this, and the mortgage is transferable as long as the new purchaser matches the criteria. So you're not locked in. At the end of the term, you can do whatever you want. You want to go to the city, apply for rezoning, or apply for severance and sell them off as individuals, create a condo board and sell them off, and you get maintenance fees for in perpetuity, whatever you want. It is yours. Many options at the end of the program, but you can sell and transfer the mortgage during. Am I locked into the, sorry, next question. What's the catch? There really is no catch. I got a question a couple times in the past week. Why isn't everybody doing this? Answer is, short answer, very few people know about it. Long answer, even less people understand it. And we got to tie in the fact that a lot of people don't know where to get the financing and don't know what properties qualify. That summarizes and concludes this part of the presentation. Heavily hammer home, these returns are not crazy, ridiculous. Find an adjective that first comes to mind when you hear it. They are viable, real projects have closed with these type of numbers. Very, very attainable, give or take what happens to interest rates and the rental market, regardless, in the next 12 months of whatever happens, the return you will receive on this, I can confidently say, will be better, far better, 3 to 4 times better than you would in any AAA market in this country outside of this program. My name was Kostas Kivelos. I'm the founder of First Access Realty and First Access Condo, and it was an absolute pleasure. And for those of you that want to further entertain this discussion, reach out to us and I will be talking to you. Have a wonderful day.